How did a family bank in 15th century Florence become one of the most powerful private institutions in Europe? The easy answer is wealth. The Medici had money, they lent to rulers, they funded artists, they became the hidden power behind Florence. But that answer misses the machine. The Medici Bank was not just a vault full of florins. It was a way to see money move. It watched church revenues flow toward Rome. It watched wool, silk, bills of exchange, currencies, branch profits, and bad debts move through Europe. Then it turned that mess into ledgers. That was the edge. The Medici could see the shape of their own business before many rivals could see theirs. Think about what that means in a medieval setting. There is no phone, no spreadsheet, no shared database, no branch manager dashboard. A letter can take weeks. A ship can vanish. A borrower can look noble in one city and insolvent in another. So the bank that can turn scattered facts into a common picture has a real edge. And that same edge explains the fall. The books began to warn them. Royal loans were freezing capital. Local managers were drifting toward courts. Political prestige was starting to beat banking discipline. The warning lights worked. The family stopped obeying them. Late medieval Europe had trade, distance, and credit. It did not have visibility. Coin was heavy. Coin was dangerous to move. Currencies changed from city to city. Credit lived in reputation, letters, and memory. A merchant could look rich in Florence and look unknown in Bruges. A banker could have capital in one branch while another branch quietly bled. The hard problem was not only money, it was coordination. A multi-city bank had to answer plain questions. Is Rome collecting enough deposits? Is Venice taking bad credit risk? Is London trapped in royal politics? Is Bruges earning money or just buying status at court? Are branch profits real or only reported? Those questions sound ordinary today. They are the daily work of risk teams, finance departments, and operating reviews. In the 15th century, they were almost a superpower. Before modern audits, those questions were slow. They were also dangerous. The Bardi and Peruzzi had already shown the risk. These older Florentine banks grew large, then collapsed in the 1340s after heavy exposure to sovereign borrowers. Scale was useful. Scale without control could be fatal. That was the blind spot the Medici entered. A great bank needed reach, but reach could kill it unless every branch became legible from the center. The Medici did not invent double-entry bookkeeping. That matters. Venetian and Florentine merchants had already been developing the method. Luca Pacioli would later explain it in print. The Medici's genius was practical. They used accounting as a remote control system. Double-entry bookkeeping gives every transaction two sides, a debit and a credit. If total debits do not match total credits, something is wrong. That sounds technical. In practice, it gave managers a way to catch errors, compare branches, and ask whether profit was real. It also changed the shape of attention. A narrative ledger says, here is what happened. A double-entry ledger says, here is what changed, where it changed, and whether the whole system still balances. That is a different kind of knowledge. The surviving evidence is fragmentary, so the claim must stay careful. Raymond de Roover argued that the Medici books became more disciplined over time. The 1427 tax records for Florence, Rome, and Venice strongly suggest double-entry practice. By the 1440s, under Giovanni Benci, the central books were more refined. A surviving secret ledger balanced in 1441 and again in 1451. The edge was not a magic formula. It was a shared language. Rome, Venice, Bruges, London, and Florence could all be different worlds. But if every branch reported through comparable books, the center could ask better questions. Which branch deserved more capital? Which manager needed scrutiny? Which loans were turning into frozen claims? Which relationship looked prestigious but destroyed return on capital? Accounting was only half the system. The other half was organization. The Medici Bank was not one simple office with distant clerks. Branches were often separate partnerships. Local managers invested capital. They shared profits. They carried responsibility. Paget and MacLean call the Renaissance Florentine partnership system an organizational invention. That phrase is dry, but the idea is vivid. The center did not need to own every local decision. It needed to own the standards, the relationships, and the right to compare. Accounting was the software. Partnership incentives were the hardware. Put those two together and the bank becomes more than a family firm. It becomes a distributed operating system. Local partners can act with local knowledge. The center can compare their results. No one sees everything, but the network sees more than any one branch. Now look at the machine. First, the papal account created trust and liquidity. Church revenue was international by design. Payments moved from dioceses, monasteries, and appointments toward Rome. Whoever helped the papal treasury collect and transfer that money did more than earn fees. They saw the map of European money flows. Second, Rome funded the network. De Roover's figures show the scale. In 1427, the Rome branch held about 100,000 florins on deposit from the papal curia. The total capitalization of the whole Medici Bank was roughly 25,000 florins. The deposits were about 4 times the partner's capital. That is the twist. The bank's power did not come only from what the family owned. It came from trusted flows they could handle. That is why the Rome branch is so important. Rome was not just another office. It was the liquidity engine. It pulled in deposits because of the papal relationship. It helped the rest of the network because trust itself became funding. In modern language, the Medici had a low-cost funding advantage before anyone used that phrase. Third, the branches became censors. Venice connected trade and finance. Bruges and London connected wool, cloth, and northern courts. Geneva and Avignon linked exchange routes. Milan mattered through politics. Each branch saw a local market. The ledgers turned local facts into a format Florence could read. This is the hidden beauty of the system. Venice did not need to look like London. Bruges did not need to look like Rome. Each branch could specialize. The common books made their differences useful instead of chaotic. Fourth, the partnership structure aligned incentives. A branch manager was not merely an employee. He could be a junior partner with capital at risk and profit share at stake. That made local initiative useful. It also made local mistakes visible. Fifth, the center used the books to allocate attention and capital. Strong branches could grow. Weak branches could be audited, reorganized, or closed. The loop looked like this. Papal trust brought deposits. Deposits funded exchange and branch expansion. Branches produced local market intelligence. Standard books made that intelligence comparable. Better control improved reputation. Reputation attracted more deposits and better relationships. Then the loop began again. This is why the Medici mattered. They built a business model that made knowledge compound. Money produced relationships. Relationships produced deposits. Deposits produced more transactions. Transactions produced more information. Information improved control. Control produced trust. That is the loop. But every information edge has a wall. For the Medici, the wall was not one rival. It was the slow conversion of an information machine into a political machine. Giovanni di Bicci and Cosimo treated the bank as an operating institution. They watched managers. They read balances. They feared loans to princes because rulers could default in ways ordinary merchants could not. Under Lorenzo the Magnificent, the balance shifted. Lorenzo was a brilliant political actor and patron, but he inherited a ruling position in Florence, not only a bank. The institution that created Medici power became one tool for preserving Medici status. The London branch showed the danger. English wool was valuable, but the politics around it were unstable. During the Wars of the Roses, wool export licenses and royal favor mattered. The Medici manager, Gherardo Canigiani, made loans to Edward IV because access depended on the crown. By 1468, an audit by Angelo Tani found Edward owing about £8,500 sterling, plus another £2,000 secured by pledges. This was not normal working credit, it was frozen political exposure. The danger was not just that a king might fail to pay, the danger was that the loan bought access. Access looked like safety. Safety made the bad loan easier to defend. That is how prestige corrupts a risk system. The Bruges branch repeated the pattern. Tommaso Portinari became entangled with the Burgundian court and Charles the Bold. The court connection looked like business development. It became a trap. A 1471 agreement allowed loans to Charles up to £6,000 gross. Later discretion expanded. Debts shifted from London added more strain. The books did not fail to warn. Audits, balances, and disputes showed the same problem. Capital was trapped in courtly credit. Managers were acting like political intermediaries. Prestige had started to override discipline. This is the moment where the episode turns. The Medici did not collapse because they lacked information. They collapsed because information lost the argument. In 1494, after Charles VIII of France entered Italy and the Medici were expelled from Florence, the remaining bank could not survive. But the economic decay had started earlier. The information system still existed. The will to obey it had weakened. The Medici pattern is one of the oldest lessons in business. Information systems matter only when they change behavior. The bank's edge had three layers. First, it had a data standard. Double-entry books made distant activity comparable. Second, it had incentives. Branch managers had skin in the game. Third, it had a control loop. The center could audit, compare, reallocate, and intervene. That is the ancestor of every modern company that says it is data-driven. But the warning is sharper than the praise. A dashboard ignored is just decoration. A risk report ignored is just paper. A financial model ignored is only a story with numbers in it. That is the brutal part of the lesson. Better measurement does not guarantee better decisions. It only creates the chance for better decisions. The Medici Bank shows the full life cycle of an information edge. Discovery. Giovanni sees that Rome's papal flows and Florence's merchant capital can be joined. Exploitation. The bank opens branches and manages them through common books. Industrialization. The partnership system scales across Europe. Erosion. Local managers and political borrowers exploit the gaps. Death. The family chooses status over banking discipline. The family survived. The machine did not. That distinction matters. A brand can outlive the operating system that created it. Investors and builders often admire the marble, the art, and the myth. The real lesson is in the ledger. When people tell the Medici story, they often start with paintings, palaces, and popes. Those things are real, they matter. But the bank came first, and the bank worked because it converted distance into visibility. Today, every company claims to be data-driven. The Medici story asks a harder question. Does the data have authority? A bank can have risk systems and still make prestige loans. A retailer can have demand data and still chase vanity categories. A software company can have product analytics and still obey the loudest customer. An investor can have a model and still override it for a charismatic founder. The positive parallel is any operator that lets information change the work. Every defect, click, shipment, or balance sheet variance becomes a signal. The signal changes action. Action creates new data. The loop compounds. The negative parallel is any institution where the dashboard keeps flashing red while leaders explain why this time is special. That phrase, "this time is special," is where many information systems go to die. The data says the customer is unprofitable. The leader says the logo is strategic. The data says the loan is risky. The banker says the borrower is too important. The data says the branch is drifting. The court says the relationship must be protected. The Medici Bank sits near the beginning of modern capitalism because it revealed a durable business truth. The first real moat is knowing your own machine better than anyone else knows theirs. But the second truth is harder. The machine will tell you when it is breaking. The question is whether you still have the discipline to listen.